Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Hey, so let's get to D.C. because House Republicans said they will vote Friday on funding to keep the government open through March 14th, provide disaster relief, and give billions of dollars in economic aid to farmers. For the latest, we go to Michael Shepard. He is senior editor for technology and strategic industries for Bloomberg News. He joins us from Washington, D.C. Michael, what do we know about what's in this latest package that seems like it will get support from Republicans and Democrats?
Well, it's unclear about whether it will get enough support to get over the line. You did outline the key components, though, and that is enough funding to carry the government over until March 14th, as well as provide billions of dollars in critically needed disaster relief and aid for farmers who've been hit economically over this past year. But there is one provision missing that Donald Trump, the president-elect, and one of his key advisors, Elon Musk, had insisted on having included, and that is an elimination of or suspension of the debt ceiling, which goes back into effect on January 1st. And that remains a loose end that could tie things up again. Likewise, it's unclear whether Democrats actually will support this measure. Remember, there was a deal that was agreed on that was on course for passage. They even had text of the bill until Wednesday, and that's when Trump and Musk intervened and upended the process. Last night, we saw a bill that both Trump and Musk had embraced go down in flames in the House, with not only all Democrats, but 38 Republicans voting against it. So this is far from fully baked, and we'll have to see how this unfolds over the next few hours.
Yeah, that was pretty remarkable to see that happen last night, especially after the support from President-elect Trump and Elon Musk. I do want to listen to what Mike Johnson, Speaker of the House, said just a little earlier this afternoon.
We have a unified Republican conference. There is a unanimous agreement in the room that we need to move forward. I will not telegraph to you the specific details of that yet because I've got a couple of things I got to wrap up in a few moments upstairs, but I expect that we will be proceeding forward. We will not have a government shutdown, and we will meet our obligations for our farmers who need aid, for the disaster victims all over the country, and for making sure that military and essential services and everyone who relies upon the federal government for a paycheck is paid over the holidays.
All right, there you have it. That is Speaker of the House, Mike Johnson, just earlier this afternoon, Carol.
Michael Shepard, I mean, man, how many times have we been through this before? Are we feeling like, okay, this is it, this is going to go through, we're not going to get some late story tonight that, we had some problems?
You know, Carol, we have seen this movie so many times before. And if you remember 6 years ago when Donald Trump was in office, we had a holiday shutdown that lasted 35 days, the longest federal shutdown in U.S. history. So this is a movie we have seen before, and it's playing out again before our eyes. And the concern is that it may go off the rails again tonight, the way it has in previous budget battles, where lawmakers have been willing to, really take brinksmanship all the way to the point of a government shutdown. And we've seen the Biden administration make clear today that they have instructed federal agencies to proceed with plans to start wrapping up operations and shutting things down if need be.
All right, good to know that. Michael, what I do wonder, too, is this just kind of a reminder that in order for things to happen, yes, there are things the president can do through executive orders, but government works through legislators and legislating. And this is a reminder that Congress can do or not do a lot of things.
Yeah, that's right, Carol. And it's important to remember that even with Trump and his incoming majorities in the Senate and the House, they are not big majorities, especially not in the House next year. He will, in fact, start the year with maybe a one-seat advantage in the House, and that will make it very difficult for him and his Republican allies, including the current Speaker of the House, Mike Johnson, to power through much of his agenda. And so consensus is important, and outreach to Democrats. It was interesting in Johnson's comments that we just played, he did not mention that sort of outreach and participation by the other side of the aisle in these negotiations. So getting a sense of whether that consensus will work, those negotiations are going to start happening next year. We're getting an early taste of it right now. Trump doesn't really quite have the mandate to simply power through. And also, as we saw last night, Republicans don't necessarily like to be told by the president what to do. The Republicans in Congress, they are a third branch of government, and especially on spending, Congress controls the power of the purse. They don't want to have that power usurped, say, by the executive branch.
Yeah, but I do wonder to what extent, in just in 30 seconds, they could get primaried and with the backing of someone like Elon Musk, who we know is there and ready to spend. Just 30 seconds.
Well, that is an open threat by Trump, and it is one that he is using or trying to use to his advantage. And we'll see how Republicans respond to that and whether they fall into line on this bill tonight.
Right, or whether Democratic fundraisers say, well, wait, we'll help you, Republicans. We'll primary you. We're setting up for another interesting year. Michael Shepard, thank you so much. Hope the evening does not go too long for all of you. Senior editor for Technology and Strategic Industries for Bloomberg News there in our D.C. bureau.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Talking about Carnival, as we said, earnings are out. They came out this morning. The call wrapping up about 3.5 years ago. That call, 3.5 years ago, 3.5 hours ago.
That's the type of day it's been, I was going to say, Carol.
It's been a long day. As Charlie mentioned, the stock rallying. Right now it's up about just shy of 7%, up the most in more than 2 months. The company reported adjusted earnings per share for the fourth quarter that beat analyst estimates. They also introduced guidance for 2025 and signaled that record levels of cruise demand will continue into the new year. For 2024, the stock is up about 40%. It is so great to have back with us Josh Weinstein. He's president, CEO, and chief climate officer of Carnival Corporation. Their brands, you know them. Their namesake, of course, Carnival, Princess, Holland America, Seabourn, many more. He joins us right now, Josh does, from Carnival's headquarters in Miami. Josh, good to have you here with us. Happy holidays. How are you?
Thanks for having me. Happy holidays, Carol, Tim. Nice to be here. Thank you.
Hey, listen, last time we talked in September after earnings, we highlighted that nearly, I think, half of your bookings were done so at record ticket prices. Now some 2/3 of 2025 have been booked. Tell us about those bookings. Are they also at record prices?
Yeah, they are. You know, our book position, as well as we did this past year, if you look at where we are today versus same time last year, we are higher in occupancy, higher in prices. As a matter of fact, it's historical levels for both, for each of the 4 quarters for 2025. So as I heard you saying before I came on, the demand for our cruises is pretty phenomenal.
Typically this time of year, Josh, how much of the following year is booked? How different is this than historical averages?
It's not. We don't give that out for various competitive reasons, but I'd say it's nicely higher. And to give you a sense of the momentum, you know, if you think about what was our booking activity, how much activity did we generate in the last quarter? So from the period of September through the end of November, that beat last year, even though we had less to sell. So we sold more for 2025, and we sold it at higher prices versus same time last year. And at the same time, we set a record for booking activity for the following year out. So in this case, 2026. So things are moving really positively across the board. And the great thing is, this is broad-based. So when we look back at 2024 and we look at our portfolio of world-class brands, we were actually higher, mid-single digit to mid-teens percentage-wise in our yields, in the revenue we generate per person per day, across all of our major brands, all of our major trades. So it's really gratifying. The team, our global team, has done a phenomenal job, and really a shout out to each and every one of them for doing what they do.
Okay, this maybe sounds a little bit stupid, but why do you think this is happening? I mean, and I'm just curious, what it is it? Tell us a little bit about it and remind us, because you do have a portfolio of brands, and it reaches across different consumers, if you will, of your brand. So give us an idea of why you think you are still seeing kind of record bookings.
We'll need an hour, right? I mean, there's so many reasons. The principle, and I remember being on with you a year ago and talking about what we'll call the price to experience ratio, and the price to experience ratio of a cruise versus the price and what you pay for a land-based alternative is nuts, right? I mean, the value that you get from a cruise for what we provide is night and day to what you can get on land, and people are recognizing that. And so we are casting a net much wider into the general population for people who will now consider cruising as a vacation alternative, people who have never cruised before. As a matter of fact, in 2024, we had over 10% more new to cruise than we did the prior year. So becoming more mainstream, breaking down myths, and that value gap is real. So we can still increase our pricing as we've been doing the last few years and be an incredible value. And I tell you, there's so many things that our teams are doing better and better every single day, from how we manage the revenue curve, right? The yield curve between the time we launch 2.5 years in advance to the time we sail. Our marketing is amazing. Our brand's doing a better job of creative marketing, getting in the consideration set, and then performance marketing, and make sure we close the deal and get the booking. You name it, we could talk about it all day, but everything is moving in a positive direction.
Josh, forgive me, we have some breaking news, so I want to jump in with that. Speaker Johnson says the House to vote on a funding bill today. He said, vote on government funding. The House, he says that the agreement has been reached on government funding, and he says there will be no government shutdown. Once again, Speaker Johnson saying that agreement has been reached on government funding, and there will be no government shutdown.
You know, I got to say, Josh, there's so much coming at us, and so many individuals and leaders, CEOs that we talk to say, you know what, we're kind of holding off until we get an idea, a clear picture of what happens in 2025. You are obviously optimistic. You see numbers and data in real time in terms of bookings. But I am curious about the upcoming White House. Is it good, bad, or neutral for your business?
You know, we had a great relationship with the Trump administration the first time around. We had a great relationship with the Biden team, and I expect that great relationship will pick up with President Trump again. So, you know, our job is to deliver amazing vacation experiences to millions of guests a year around the world. That is what we do, and we do it very well. And every single year, there is something, right? Because we are global and the macro economy and the geopolitics are what they are. When I was with you a year ago today, we didn't have Red Sea on the radar screen. The Baltimore Bridge hadn't collapsed. You know, hurricanes hadn't done the damage that they did in the United States. Government elections getting thrown for a loop in Europe, like the UK and now Germany. None of that was on the radar screen, and we outperformed our December guidance by $700 million. Our job is to deliver no matter what the world might bring, and we'll continue to do that.
So I do wonder, when you look at 2025, what macroeconomic factors, what geopolitical factors concern you the most, Josh, you know, when you think about the company's 2025 performance potential?
Oh, man, you know.
Sorry, I'm asking you a question.
Yeah, that's all right. I'm not going to single anything out. I mean, like I said, our job is to deliver. We deal with whatever the world might bring. We are nimble. Our team is amazing at reacting as they need to. But more importantly, we are proactively doing what we need to do to position our ships with our guests the right way and delivering on board. So the world will turn, crises will come and go, and people will keep cruising.
You've been President, CEO, Chief Climate Officer since August of 2022. So you've been in this position for a couple of years. Relative to the last couple of years, how would you describe the health of the American consumer right now? Same, better, worse?
We're just seeing continued positive momentum. So I think it's hard to say anything, but it's just as good now as it has been for the last few years for us in particular, given the record yields that we're just coming off of, and we're building on top of that. And you got to remember, we're a global company. So yes, the United States is the biggest cruise market by far, and we're doing incredibly well in the United States, but we are also the biggest in the United Kingdom, the biggest in Germany, second biggest in Italy, second biggest in Spain, Brazil. So we have an incredible global presence. And the fact is, economic cycles come and go, crises come and go, macroeconomics will flow different times in different places around the world. So our portfolio approach of being in these phenomenal markets really serves as a great hedge for us, because things will come in their cycles and leave their cycles at different times.
So of those geographic markets that you mentioned, even those that you didn't mention, where you do operate, where you do play, where are you most bullish?
Where am I not? If you think about cruising, right, and you think about our brands, we're about a third of the market, let's just say in broad terms. If you take the whole cruise market and you put it into a bucket with all of the vacation alternatives at the same time, we're about 2 to 3% of the overall vacation market. And so how can you not be bullish when we are so underpenetrated as a global industry? I mean, it is remarkable what inroads we can make by just getting people who have never cruised before to consider cruising. And I'll tell you what, I don't know Disney's strategy any more than anybody else does from the outside, but I do know that they talked an awful lot lately about reducing the investment in their land because they want to build more investment into cruise and double the size of their fleet. I think that is very, very telling, and I think it's a brilliant idea.
Okay. And you guys have invested in your fleet. And I'm also curious about, when I did a deep dive on the company and I got off at Grand Turk, you guys have a port there. And I am curious about these offshore destinations for Carnival travelers. How significant is the July 2025 opening of your Celebration Key private island destination to the company's full year revenue outlook? I am curious about how this moves the financial needle, these offshore ports that are yours, that you guys highlight.
Yeah, absolutely. They're a critical piece of our strategy. So even today, without Celebration Key, we've got 6 jewels in and around the Caribbean, and we took about 6.5 million guests to one of our destinations in that geography. That's about equal to the rest of the industry combined with theirs. On top of this, we've got Celebration Key, which is going to be a phenomenal guest experience built from the ground up for Carnival Cruise Line and their idea of fun and just a wonderful guest experience on board. And there's a lot that we could go into, but it's going to be phenomenal. Now, with respect to 2025, there's really not that much of an impact because we don't open until July with a handful of cruises, and then we build up. So for the corporation overall, it's only about 5% of our itineraries in 25 will touch Celebration Key. That ratchets up to about 15% when we get to 2026. On top of this, we've announced that we're doing some major investment in one of our other existing destinations, traditionally known as Half Moon Cay, and rebranded Relax Away at Half Moon Cay because it's a different vibe than Celebration Key. It is a beautiful tropical paradise, white sand beaches, and what we want you to do there is lean into the beauty and the pristineness of that location and the crystal blue waters and relax and enjoy yourself and unwind. And we're going to be able to marry these two types of experiences on the same itinerary. So you get the idyllic and the ultimate beach days across those portfolios.
Well, listen, great to check in with you. And investors are certainly respecting the optimism that you have put out, certainly in earnings and then on your call with analysts. I'm so glad we could get some time with you. Josh, happy holidays to you and your family, and look forward to talking to you in the new year. Josh Weinstein, folks, President, CEO, and Chief Climate Officer of Carnival Corporation, joining us from Miami.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
In the third quarter of this year, the most recent for which data is available, venture deal making hobbled along at a slightly better pace than last year ago. This is in dollar terms. Cash, though, went to a handful of companies. It underscores the increasingly selective spending in the sector. Hello, AI. There were an estimated 3,777 U.S. deals for $37.9 billion in the third quarter. It's about an 8% uptick in the value of transactions compared to the earlier period. This is according to data from PitchBook. Again, this is for the third quarter,
right? Because
that's the most recent completed quarter we have.
Nobody talking about a record year, though, right?
No. I mean, you have to go back a few years to see that. the question is, what will things look like in 2025 on that front, and then also on the IPO front?
It's a great question. We've got a great guest to dig into that. Jeff Grabow is back with us, U.S. venture capital leader over at EY, joining us from Palo Alto. Good to have you here with us. Before we get into your outlook, you're in the right place to be talking about kind of what's going on in the venture capital world. But
Just got to step outside on the Sand Hill Road and go and talk to the folks who are actually spending the money.
What's going on? I mean, talk to us about, creation of new companies, money going into them, where they are in those, venture rounds. We've talked for years about how much private money is out there enabling startups to stay private for a lot longer. So tell us about kind of the end of 2024 and then looking into 2025.
Yeah, so 2024 ends on a high note. Q4, we kind of flash numbers where we're seeing right now we're about $60 billion, which is an up quarter. 2024 is about 178. Probably it'll flash in a little higher than that. It's the first up year in 2 years, and it's actually the third highest year on history. And as you were talking earlier, you got to go back to 2021 to see the peak, and we're still we're a bit off that, and probably a bit a ways from seeing that again. It's the 7th straight year of $100 billion raised by venture-backed startups. One of the things we have seen, the deal count has continued to drop. It's the lowest deal count since 2013. And the activities you alluded to earlier is extremely AI driven. Many of the top 10 deals in the fourth quarter were AI deals.
What happens if you remove some of the big deals from this, the open AIs, the Anthropics, and I don't know, maybe the SpaceXs of the world? What happens if you remove those huge ones?
Well, the mega round deals have been driving a lot of the activity for quite some time. And I think it's as pronounced as it's been in its impact. If you didn't have AI, the tone of the story would be extremely different. You'd be doing comparisons to 2001.
That's interesting.
I am also curious that you said that the deal count has been dropping, and we talked AI. Mm-hmm. How much money is really, going into AI, and are then some other ideas, some other ventures not able to access the capital they need because of that?
Well, I mean, we've got, there's going to be a have and have nots environment, because if you're raising today, you don't have the baggage of the past. We've come through a peak period. And there's a lot of companies that haven't raised in a couple of years. And that's kind of like the length that people like to have in their pipeline of cash. So they're coming back into market in a very different environment. And the bar has gone up. And a lot of times these companies haven't produced a lot of increase in their business outlook. So that it makes it very hard to raise. So that's driving less activity on some of those companies. And then on the flip side, you have the haves, which are definitely AI driven.
We talk about crowding out in the public markets in the sense that, this year we saw NVIDIA absolutely just dominate when it came to the index level, other mega caps as well. Does that happen in the startup world, where the mega deals that are driving the volume here are crowding out funding of smaller startups?
Well, I wouldn't say it. I think the phenomena that it has is it promotes others to go to market to kind of match the pace. So if a large language model goes out and raises a large round, you're apt to see others try to keep pace, because now we're potentially playing in an environment where cash is a weapon and you don't want to be low on ammunition.
Yeah.
Go ahead.
No, go ahead.
I was going to say, does that change going into a different administration, and especially in an environment where many thought, if we were talking a year ago, we'd think that rates would be a lot lower than they are now. But still, investors do think rates will move lower in 2025. In a lower rate environment, does it make raising cash easier?
Well, when you think about the fund formation side on the equation of capital moving into the venture asset class, if there's less yield in the market, that pushes people to higher risk opportunities to gain yields. I think, the environment that we're seeing is, this feels very much like 95, 96 at the birth of the internet. And a lot of people talk about that. There's some similarities, there's some differences. A lot of infrastructure is being built right now. Kind of the ground floor is being laid. So that's why we're seeing so much capital being deployed. The internet was a consumer adoption story. Consumers adopt at a different rate than enterprises. But I think if you go back, 10 years from now, I think we'll look at an up and to the right trajectory.
Well, you say it's going back to the mid 1990s. We all know what happened at the end of the 1990s and into the early 2000s. So I'm chuckling a little bit, but does it end with a whimper the same way that the dot-com crash did?
Well, the interesting thing that's going on right now that I find fascinating, we've never been in a scenario like this, is, we're coming off normally it has been more of a boom bust environment, but we've, come from a peak, probably going from 2015, 2016 through 2021 of seeing a huge ride up and then coming down for a couple of years. But now with AI, we're booming again. So normally we've been in boom bust cycles, and now we haven't even really rationalized the downside, and we're off on a boom again with a great, technology opportunity.
Hey, Jeff, a couple of things I wanted to ask you. And in regards to AI, one of the stories that has really popped up in a big way in the last 6 to 12 months is powering AI, what's necessary in order to do all those computations, data computations. Having said that, I am curious about VC money going into that area. We know some of the big tech companies, whether it's Meta, whether it's Alphabet, and others are, certainly investing in energy needs, hooking up with energy companies to build out nuclear and other forms. But I'm just curious what you are seeing in the VC world on that level.
Well, we've seen upticks in, kind of energy deals, energy-related deals. I think this is a good opportunity for a wide variety of solutions to come in and solve that problem, because the energy demands, with the amount of, data center infrastructure that's being put in place is immense. And something needs to happen to help solve that, or else energy could be a bottleneck in the deployment. So, and typically when we have these kind of challenges, technology comes to play. So hopefully we're going to see scenarios that, and it's going to be a mix of, it will be a mix of solutions. I don't think there's necessarily a silver bullet out there, but I think it's going to be a mix of, nuclear generation, thermal reduction of energy, consumption, cooling of data centers. A lot of these things will come into play, and hopefully it will be able to continue to have its rollout.
Hey, one of the other things I wanted to ask you, there's venture, right, and capital raises and different rounds, if you will, and then usually it leads up to an IPO. But we have a great story by our Sarah McBride earlier in the week, and it says secondary transactions involving venture-backed startups are on track to hit a new high this year as companies like OpenAI, SpaceX, and Stripe organize tender offers to get employees paid, and investors look for ways to offload stakes outside of initial public offerings. I am curious, do you think that continues? And is that kind of, I don't know, problematic for, the venture world, who is always looking for kind of their exit?
Well, they're getting rid of part of their stakes, and it's helping them work with their LPs, because, the people that give them money, a lot of these are pension funds, and pension funds have monthly obligations to put checks in the mailbox of their pensioners so that they can eat and, survive. So it's a part solution. We're hopeful that 2025, you're going to start to see a comeback in IPOs. I think it's going to take a little bit of time to happen, but the IPOs will provide most of the venture returns, I believe. And, we were at our strategic growth forum just right after the election and talking to some of the exchanges, and their phones had started to ring. So I think a lot of people will start to look at this path, and that's, that provides more returns than, secondary offers, because you're taking a discount. You're taking a discount to market to get a secondary done.
All right, got to leave it on that note. Jeff, thank you so much for finding time for us. Have a good New Year. Happy New Year and happy holidays. Jeff Grabow, he is U.S. Venture Capital Leader over at EY, joining us from Palo Alto.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car, I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, just got about 18 minutes left in today's trading session, getting ready to wrap up the Friday trade and also, of course, the week trade. But we do have stocks just coming off or just off their best levels of the session. Charlie breaking down those numbers, but more than 1% gains on the S&P 500, the Dow Jones Industrial Average, and the NASDAQ 100. And as we've been saying really throughout the day, broad-based buying. And so investors coming back into the market after quite a sell-off following the Fed decision on Wednesday.
Okay, let's talk a little bit about equities, but also about alternatives. For that, we get to Miguel Sosa, head of market research and strategy at the institutional alternative asset manager, Bluerock. We've got about $18 billion in assets under management. Miguel joins us from beautiful and sunny San Diego, California. I haven't even checked if it's sunny in San Diego, but I assume it is, Miguel. Is it nice there today?
It is about, we're seeing about 70 degrees today. Unusually warm for December, but yes, thank you for having me.
Sounds kind of dreamy.
Yeah, it sounds nice. I look outside and there was some snow happening out here in Manhattan a little earlier. I want to talk with you just a little bit about the market environment as we wrap up the year here, how you're thinking about deploying new assets, and just get your view on a week that, kind of got a little bit of a reset from the Federal Reserve. What are you watching?
Sure. Yes, so it was an interesting week for sure, only because the Fed, as you mentioned, cut rates, and yet markets reacted, call it pessimistically or bearishly. But we see that as a short-term hiccup. In our view, inflation continues to moderate. The Fed has communicated that they're not going to be as aggressive in cutting rates in 2025. And we at Bluerock see that as a Goldilocks scenario where rates are not going to go back to their 0% rates or levels that we saw several years ago, but we're behind the 5+% peak of federal funds rate. And so it still is a lender's world versus a borrower's world a few years ago. So in our view, alternative private credit continues to be attractive. And for the other alternative classes that we see, private real estate is also starting to see stabilizing, if not hopefully soon, decreasing cap rates, which will act as a tailwind instead of the headwind that real estate has seen in the last couple of years.
I want to ask you on the real estate alt asset class. Our Patrick Clark, Neil Callahan, and Jack Siders putting out a Bloomberg Businessweek story earlier in the week, and it basically said, the headline on it is office real estate is facing, quote, a year of reckoning in 2025, and just talks about commercial real estate bracing for losses in the new year as lenders run out of patience and borrowers struggle to refinance loans due to high interest rates. Delinquencies are rising. Over 10% of office building loans in arrears. Some owners are selling properties at a loss to avoid foreclosure. What is your read on office property right now?
We at Bluerock don't disagree with that assessment. One way to phrase it is that office is potentially under demolished, meaning that there is a lot of supply, and although companies try to implement return to work, it's hard to drag workers back into the office for 5 days a week. And so we've divested and stayed away from office for several years now. We see opportunities in other sectors. Office will continue to be challenged. And so some of them may be converted into multifamily residentials. It's hard to really turn an office space into an infill or call it an industrial specialty type of space. But office will continue to see challenges. At the end of the day, what really matters is, can a given space, whether it's office or whether it's another sector, generate income through leases?
Miguel, so what within commercial real estate do you like? Where do you find, what's opportunistic, I guess I should ask, and maybe looks poised for a good year in 2025?
Sure. We see a couple of opportunities. The first one is the industrial sector. Us here in the U.S., myself guilty as well, continue to buy more things online. And that drives demand for industrial warehouses that are close to city centers. At the same time, we're also seeing opportunities in the specialty sectors. So that's this a little bit of a hodgepodge of all those real estate sectors that don't fall under the big four categories. You can think of data centers, life sciences, senior housing, student housing, but in our view, really data centers is a key opportunity because of our insatiable demand for more and more data and more video on our phones.
How are you investing in data centers?
There's a couple of opportunities to invest. We see, in our view, what comes across our desk is direct co-investments to large built-out data centers, both in the US as well as abroad. In our view, what we do then is offer that to individual investors. So we see ourselves as an access point for those larger direct investments, whereas individual investors can contribute as low as $2,500 to our commingled products.
Private credit. You know, one of the things I think we still talk about, we were talking with, was it S&P Moody's yesterday?
This week,
Moody's?
yeah.
Yeah, and just, you know, the lack of transparency and disclosure in the private credit world, as increasingly folks are looking for more investors, more retail investors to be able to tap into the private credit world. What are your concerns as someone who has been investing in that, you know, world and providing that opportunity? What is the one thing we should be watching out for within the private credit world?
Private credit has grown into a very large space in the last several years. And to your point, it can be concerning when a space grows very quickly. We at Bluerock see ourselves as offering alternative private credit where the appeal is there of private credit, of high yields and relatively low volatility, without some of the latent risks or with additional complements. Our view is that some of the larger concern is that private credit is not traded. And so sponsors and asset managers that do invest in private credit have to hold it to maturity. And at their best or fair value, believe that it will pay at maturity until it doesn't. Right? So it's a very almost binary scenario. Yeah. Certainly there's somewhere in the middle. But if there isn't that opportunity, it's very hard to get out of those spaces. So in other words, just because something is low volatility doesn't necessarily mean it's low risk.
All right. Some words of caution and some thoughts on that. Miguel, thank you so much. Really appreciate the conversation and look forward to continuing in the new year. Miguel Sosa, Head of Market Research and Strategy over at Bluerock, as we mentioned, Tim did in the intro, $18 billion in assets under management and in the alt asset space, something that we talk a lot about, whether it's private credit or certainly the real estate and commercial real estate in particular.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.